You don't lose money because your analysis is bad. You lose because your position size is lying to you. Every blown account begins long before the stop loss. It begins the moment the trade is sized too large to survive normal market noise, the kind of random vibration that professionals expect, but amateurs mistakenly interpret as proof that their idea is wrong. Professionals understand this instinctively because they've lived through the quiet brutality of oversized trades. Amateurs refuse to see it. They treat the market like a courtroom where the stronger their conviction, the bigger their size should be, as if passion could force the market to obey. But markets don't reward conviction. They only reward survivability. This is where the 1/5 position rule enters. Never size a trade larger than 1/5 of the amount you emotionally want to risk. If your gut tells you to risk $5,000, the professional forces himself to risk only $1,000, not because he's fearful, but because he knows conviction creates blindness, and blindness widens losses. Let me give you a quick scenario. A trader sees what looks like a breakout forming. The candles tighten, volume increases. The chart whispers opportunity. He feels certainty rising, the kind that makes amateurs believe they've found their moment. So he risks 20% of his account because this setup is different. Then the tape wobbles. A tiny false tick prints below the pivotal point. His stop triggers. He loses 20% in seconds. And here's the twist he never sees coming. Even if the trade later works, he's already psychologically crippled. He'll hesitate on the next one. He'll snatch early profits on the second. He'll chase the third when frustration peaks. Oversizing breaks the trader long before it breaks the balance. Professionals flip the script entirely. They size tiny at the beginning, not because they doubt themselves, but because they know the market must confirm their idea before they deserve to earn. They let confirmation pull them in, not excitement. They build slowly and deliberately, as if each addition must be justified by price strength rather than desire. They follow a cold maxim Livermore lived by. A trader's first job is to stay in the game. Survival is not passive. It's an active discipline that filters out impulsive decisions. Before we talk about pyramiding, scaling, risk asymmetry, and how the 1/5 rule creates explosive reward profiles, you must understand one uncomfortable truth. Oversizing doesn't just destroy your risk-to-reward ratio. It destroys your ability to think. It hijacks your psychology. It pulls you out of the rational mind and pushes you into panic, into the distorted tunnel vision that always precedes catastrophic mistakes. The amateur believes his biggest problem is poor analysis. The professional knows analysis collapses under pressure when size is too large. This is the amateur-professional identity gap, the divide that determines who survives long enough to become consistent. Amateurs size based on conviction. Professionals size for survivability. Amateurs bet big when they feel strongly. Professionals stay small until the market proves the idea. Amateurs escalate size when excited. Professionals escalate only when already winning. This single contrast explains why most traders lose despite good setups. Oversizing suffocates their clarity. It makes normal pullbacks feel like disasters. It makes small pauses feel like the end of the trend. It makes every tick an emotional event rather than a piece of information. Let's return to our scenario. The trader who lost 20% now spirals into hesitation. His next trade is smaller, tentative, late. He doesn't trust himself. He doesn't trust the setup. When the market finally moves in his favor, he snatches profits prematurely because he fears another wound. Then he watches the trend run without him. Frustration builds. On the third trade, he oversizes again out of desperation. This cycle destroys accounts not because traders lack intelligence, but because they lack structure. Professionals avoid this trap by anchoring themselves to the 1/5 position rule. They know that if their emotional number is $5,000, they must risk only $1,000. This constraint keeps their thinking clear and their reactions controlled. They execute stops mechanically. They wait for confirmation patiently. They watch the tape without projecting their fear onto it. They understand that conviction masquerades as certainty, and certainty breeds blindness. Blindness is deadly in a market built on ambiguity. This controlled approach builds confidence. Confidence built on discipline, not bravado. Confidence built on structure, not impulse. Confidence that allows patience to deepen rather than evaporate. That patience is what keeps the professional in the game long enough to benefit from rare, high-quality trends. The amateur, chasing the illusion of quick profits, burns through emotional capital far faster than financial capital. Each oversized trade erodes his self-trust until trading becomes an emotional battleground instead of a strategic one. The truth is simple. Losses come from oversizing, not bad analysis. If most traders cut their size by 80%, their results would improve overnight. Their judgment would stop collapsing under pressure. They would see the tape more clearly. They would respect pivotal points instead of reacting to noise. They would wait for confirmation instead of forcing entries. They would treat stops as structural boundaries rather than emotional threats. They would think like professionals instead of gambling like amateurs. Your job now is to absorb this principle deeply. The 1/5 position rule is not about trading smaller. It is about trading smarter. It neutralizes emotional distortion. It keeps your mind steady. It protects your ability to evaluate, to wait, to observe, to respond rather than react. It rebuilds your relationship with uncertainty. It rewires your habits around survivability rather than conviction. It gives you the psychological strength to stay consistent when others panic. Oversizing reaches deeper than fear. It alters the very framework through which you interpret price action. When the stakes are too high, every tick feels like an attack. Every pause feels like a betrayal. Every retracement feels like a signal that you were wrong all along. Your breathing shortens. Your shoulders tense. Your judgment narrows. You stop seeing structure and start seeing threat. This is why amateurs misread charts they normally understand. They're not analyzing the market. They're analyzing the fear their size created. The professional never allows himself to enter this distorted cognitive state. His small size guards his reasoning like armor. He can wait for the market to reveal its intention because he is not emotionally entangled in the outcome. If price tests a level, he reads it neutrally. If volume expands, he notes the shift calmly. If momentum fades, he reassesses without panic. His ability to think clearly is preserved because his capital exposure is aligned with his psychological capacity. The amateur, oversized and overexposed, cannot see the same chart. Consider the difference in internal dialogue. The oversized amateur thinks, if this fails, I'm ruined. The professional thinks, if this fails, I'll take the next one. The amateur watches ticks like bullets. The professional watches structure like a map. The amateur trades with fear of losing. The professional trades with the intention of surviving. These differences compound until they define identity. And identity is the foundation of consistency. No trader becomes professional until he stops acting like an amateur on the inside. That transformation doesn't begin with indicators or systems. It begins with risk. It begins with size. It begins with accepting that being wrong is normal and harmless when your position size is small enough to ignore. Oversizing makes wrongness unbearable, which is why amateurs fight losses instead of accepting them. This is why the 1/5 rule is so powerful. It forces acceptance. It forces humility. It forces clarity. When your size is small, you don't need to be right. You need to follow structure. You don't need to predict. You need to respond. You don't need the market to reward you immediately. You need it to reveal its intention. This relational shift is the seed of professional thinking. When you adopt the 1/5 rule, you give yourself room to observe without emotional contamination. You give yourself permission to wait through boring tape. You give yourself the safety to take multiple attempts at the same setup, because each loss is trivial. You create the psychological environment necessary for patience. You build internal bandwidth instead of burning it. Most traders never give themselves this gift. They never create the conditions in which good decision-making can flourish. They sabotage themselves with size before the market ever tests their strategy. They think they have discipline problems, but they have size problems. They think they need better entries, but they need smaller positions. They think they lack courage, but they lack clarity. All of this leads to one conclusion. The 1/5 position rule is not a guideline, but the foundation of professional identity. Without it, everything else is fragile. With it, everything else becomes possible. And now that you understand the destruction caused by oversizing, you're ready for the next chapter, the deeper psychological mechanism that explains why size manipulates perception, collapses cognitive bandwidth, and guarantees sabotage even when your analysis is right. Here's the paradox most traders never solve. The larger your position size, the smaller your ability to think. This isn't a metaphor or a motivational slogan. It is the mechanical reality of your own biology, turning against you in the moment you need clarity the most. You've felt it. That tightening sensation behind the eyes, the shallow breathing, the sudden hyper-focus on every tick as if each movement is a threat. Your heart rate accelerates just enough to make your thoughts jittery. Your decision-making horizon collapses from minutes to seconds, and then into split-second reactions that feel rational, but are really reflexes disguised as logic. A stop-loss you planned calmly the night before suddenly looks unreasonable, too tight, too exposed. Your plan feels wrong, even though the market hasn't done anything unusual. The problem is not your strategy. The problem is not volatility. The problem is not the setup. The problem is that an oversized position has triggered your nervous system to interpret normal price movement as mortal danger. Oversizing activates the same neural circuitry used when a predator is charging toward you. And when your brain believes you are in danger, it doesn't ask your permission before hijacking your cognitive system, it simply takes over. In that instant, your prefrontal cortex, the part responsible for logic, patience, and long-horizon thinking, is partially shut down. The lizard brain, the ancient survival mechanism that operates on instinct and impulse, takes the wheel. And the lizard brain only operates on two modes, fight or flight. Every trading mistake amateurs make, every reckless adjustment, every impulsive decision that looks irrational in hindsight, is born from this neural hijacking. They aren't weak. They aren't undisciplined. They're simply oversized. Professionals understand this, which is why they avoid entering the biological panic state at all costs. Amateurs enter it daily. Professionals know that once the lizard brain is in control, it doesn't matter how many rules you memorized or how well you understand your strategy. Nothing logical survives inside the emotional storm triggered by oversized risk. This is why small size is not a suggestion but a requirement. Consider a simple anecdote that plays out thousands of times a day across the world. A novice trader has a $10,000 account and risks $2,500 on a single position. 25% of his entire account is exposed. At first, he feels excited. He imagines the upside, the fast victory, the big score. But the tape pulls back slightly, a completely normal fluctuation. Under normal size, he would shrug it off. But at 25% exposure, his nervous system interprets the retracement as a threat. His mind floods with urgency. He stares harder at the screen. His hand hovers near the close button. He moves his stop, convincing himself it's temporary. Then he adds to the position to improve his average, not realizing he is amplifying his fear. In 5 minutes, he has made 5 decisions, none of them part of the original plan. He isn't trading the market anymore. He is trading the physiological spike in his bloodstream. And because he is operating from the lizard brain, every decision he makes will be reactive, defensive, distorted. His performance collapses, not from lack of knowledge, but from excessive biological load. Now contrast this with the professional operating in the exact same market environment. Same setup, same tape, same candles. But he risks 2%, a size so small relative to his emotional threshold that his nervous system stays quiet. He has no adrenaline spike, no tightening of the chest, no distorted perception. The same pullback that triggered panic in the novice barely registers for him. Because his mind is not consumed by survival signals, he has access to the full decision-making power of his prefrontal cortex. He sees the retracement for what it is, a test of trend strength. He waits. He observes. He lets the market confirm continuation or reveal weakness. Where the amateur spirals into compulsive behavior, the professional remains anchored in objective perception. Counterintuitively, this detachment gives him more control, not less. He is not emotionless. He is simply not overwhelmed. And this is the great truth amateurs never realize. Clarity is not created through discipline, motivational quotes, or brute force willpower. Clarity is created through proper size. Risk that is too large distorts the signal. Risk that is manageable reveals the signal. This is the first hidden purpose of the 1/5 position rule. It protects your prefrontal cortex from being sabotaged by your own biology. It keeps you in the cognitive state where strategy can actually be executed. It makes emotional stability a structural outcome rather than a psychological struggle. The amateur thinks he needs to become stronger, more stoic, more disciplined. But emotional strength is irrelevant when the nervous system is in panic mode. You can't out-discipline biology. You can only out-structure it. When your brain isn't in a fear response, you can follow rules effortlessly. You can hold positions without self-sabotage. You can read the tape accurately, instead of through the haze of anxiety. You can spot pivotal points not as threats, but as opportunities. You can wait without suffering. Patience becomes effortless, because there is no internal tension fighting against it. Most traders don't fail because they lack skill. They fail because their risk size keeps them in a state where their skill is inaccessible. The amateur always asks the wrong question. How much can I make on this trade? Without realizing that this mindset immediately pushes him toward oversizing, because greed has no built-in limit. The professional asks a far different and far more powerful question. How much pressure can my mind withstand without distorting the signal? This single question reframes the entire game. The amateur sees size as a path to quick gains. The professional sees size as a lever that controls mental clarity. The amateur sees risk as a tool to accelerate success. The professional sees risk as the mechanism that determines whether he will have access to his own cognition. Because when your mind is calm, you trade well. When your mind is overloaded, you trade like a stranger to your own strategy. This is why the 1/5 rule exists. It removes you from the danger zone. It creates a state where you can observe instead of react. It builds a mental environment where the market becomes readable instead of chaotic. When position size is small, the lizard brain stays dormant. The prefrontal cortex remains active. Logic stays online. This is the condition under which good trading occurs. And this is the psychological edge amateurs never cultivate. The edge of staying in the cognitive zone, where the market's information can actually be understood. When your size is wrong, nothing works. When your size is correct, everything you've learned begins to surface naturally and consistently. Oversizing is not just a financial mistake, it is a biological mistake. It traps you in a loop of reactive behavior that feels purposeful in the moment but is always destructive in hindsight. Every trader who has blown up an account or taken a catastrophic loss shares the same root cause. They traded from a state of nervous system dysregulation. Their perception collapsed. Their rationality dissolved. Their ability to wait, observe, and execute vanished. They became prey to their own adrenaline. The market did not beat them. Their biology did. And this brings us to the bridge into Chapter 3, because once you understand how the 1/5 rule protects the mind, you can finally see how it transforms execution. When your brain is calm, your stop placement becomes cleaner. You don't suffocate your trade. You don't widen stops impulsively. You place stops at truly logical levels that reflect the actual structure of the market, not your fear. Confirmation becomes visible because you're not frantically searching for reassurance. You can distinguish between real strength and random noise. Your ads become strategic instead of emotional. Pyramiding becomes methodical instead of reckless. You stop trying to make the trade work and start letting the trade prove itself. All of this becomes possible only when your cognitive bandwidth is intact. Chapter 2 ends here because the next layer requires a shift from the psychological to the tactical. From understanding why your mind needs small size to understanding how small size shapes every micro decision in your process. In Chapter 3, we enter the tactical side of the 1/5 rule. How this structure creates cleaner stop placement, clearer confirmation signals, superior pyramiding, and a compounding advantage that amateurs never access. The mental advantages you gained here become the foundation for everything that follows. Now that you understand why controlling size protects your mind, here's the part amateurs never consider. Proper position sizing is the hidden machinery that allows your entire trading system to work as intended. Most traders don't have a strategy problem. They have a size problem that quietly interferes with the mechanics of that strategy until nothing behaves the way it was designed to. A stop that should protect capital suddenly looks too wide. An entry that normally feels clean now feels shaky. A normal pullback suddenly looks like a reversal. All this distortion comes from one simple thing. The position is too large for the trader's emotional bandwidth, and because the size overwhelms him, every element of the system gets warped. Once you shrink the size, the structure of your method begins to function the way it was meant to, and the first place this becomes obvious is in stop placement. When your size is small, your stop can finally sit at the true pivotal point, instead of the point your fear prefers. The pivotal point is the place where your trade thesis is actually invalidated by price action, not where your discomfort flares up. The amateur doesn't see the difference. He believes his tight stop reflects discipline, but in reality, it reflects anxiety. He tightens because he's oversized, and because he's oversized, he needs the market to reward him immediately. This creates a trap. His stop sits exactly where noise lives, not where structure lives. The 1/5 position rule solves this problem at the source. When your risk is small relative to your account and your emotional bandwidth, you no longer feel the pressure to shrink your stop to make the loss feel smaller. You keep the stop where it belongs, at the pivotal point the market has actually shown you. Imagine a trader risking only 5% of the emotional amount he originally wanted to risk. His position is light enough that his stop can sit comfortably under the structural level that truly matters. Price wicks below the level for a few seconds before ripping higher. The wick is meaningless to the market but deadly to the oversized trader. The amateur would have been blown out instantly, then watched the move run without him, building frustration, confusion, and the sense that the market is unfair. The professional doesn't suffer that fate because his size allows his stop to function as a structural gate instead of an emotional shield. And from that, we pull a maxim. Your stop works only when your size doesn't scare you. It sounds simple, but it's a principle that takes most traders years to learn, usually through repeated damage. Once stop placement becomes precise, the next advantage unfolds naturally. Confirmation becomes possible. Oversizing forces amateur traders to enter early because they want a cheap price. They fear missing the move. But deeper than that, they fear taking the trade only after price has traveled a distance that will make their oversized position feel expensive. Because they're large, they crave perfection. They need the best entry, the lowest tick, the top of the pivot, the moment where the chart looks pristine. This fantasy of perfection only exists because the size threatens them. The professional, using small size guided by the 1/5 rule, enters later because waiting does not create pressure. Waiting becomes a position. A professional doesn't mind if confirmation requires price to move away from his ideal location because he knows his size can handle the distance. Counterintuitively, the professional enters the market at a time when amateurs feel they are late. But the irony is that the professional's entry is safer, cleaner, and anchored in confirmation rather than fear of missing out. This shift seems subtle, but it changes everything. When a trader enters early with large size, he commits before the market has shown its hand. He is exposed to chop, noise, and uncertainty. And because he's oversized, every minor fluctuation feels catastrophic. This emotional pressure leads him to close early, reverse the position, tighten stops, or interfere with his plan. Meanwhile, the professional with smaller size enters later after the market confirms direction, which means his trade begins with strength rather than hope. He is carried by the flow of confirmation instead of battling the noise that punishes early, oversized entries. This is the quiet advantage of the 1/5 rule. It buys time. It buys clarity. It eliminates urgency. And without urgency, the trader can finally follow the one rule amateurs always ignore: waiting is a position. But the most powerful structural benefit of the 1/5 rule reveals itself in the third pillar. Pyramiding becomes safe rather than reckless. Pyramiding is one of the most misunderstood tactics in trading. Amateurs treat pyramiding like leverage. They add size when they feel confident, when the trade feels good, when they want to accelerate the reward. But professionals don't pyramid because of excitement. They pyramid because the market is already paying them. They add to winners, not to hope. They scale when the move proves itself, not when they want more action. The 1/5 rule ensures the initial position is deliberately small, a probe, a feeler, a test of the market's intention. Instead of going heavy first and light later like amateurs do, the professional goes light first and heavy later, structuring the position to expand only when the market demonstrates strength. This reversal of order changes risk to reward dynamics entirely. The amateur loads heavy at the bottom, then holds a large position through the riskiest part of the move. His pyramiding comes later, ironically when probability has improved, and by then, he has too much fear and too little margin for error. The professional starts tiny. His first position is so small that it barely matters psychologically. He watches price behave. He waits for the tape to strengthen. He waits for confirmation. Once the market begins to move in his favor and breaks above key structural levels, he adds more size, not because he is confident, but because the tape is telling him it's time. This is Livermore, 101. Pyramid only when the market pays you. Never before. Small initial size is what makes this tactic safe. Because the first position is small, it cannot damage the trader. Because it cannot damage the trader, he feels no fear. Because he feels no fear, he can read the tape clearly. Because he can read the tape clearly, he adds only when confirmation appears. And because he adds only with confirmation, the trade gains a mathematical profile that is entirely different from a large early entry. The trader's size gets heavier as the trade becomes safer, not riskier. This inverted structure is what produces asymmetric reward large gains built from small initial exposure. Every piece of the system improves when size follows the 1/5 rule. Stops sit where they belong. Entries flow with confirmation. Pyramiding aligns with proven strength. And most importantly, the trader's psychological load remains light enough that he doesn't distort price action with fear-driven interpretation. His eyes stop searching for danger and start searching for information. His mind stops reacting and starts observing. Everything becomes calmer, cleaner, and more systematic. The system begins to work because the size no longer corrupts it. And that brings us directly into the next step. Because once your structure aligns like this, the math begins to tilt heavily in your favor. What seems like a psychological rule suddenly reveals itself as a mathematical necessity. In Chapter 4, we will take this deeper, exploring how the math of asymmetric reward amplifies when you follow the 1/5 rule, why pyramiding only works with tiny initial size, and why oversizing guarantees negative expectancy, even when your analysis is excellent. The numbers will expose the truth. Strategy does not fail because it is wrong. Strategy fails because size suffocates it long before it has a chance to breathe. Most traders think they have a psychological issue, but more often they have a Sakharing math issue that disguises itself as emotion. Oversizing destroys risk-to-reward ratios not because the market is unfair, but because the math of large losses is fundamentally asymmetric. A trader can do nearly everything right and still go broke if his size sabotages him before his process has a chance to operate. The numbers reveal this with brutal clarity. A 20% loss requires a 25% gain to return to break-even. A 40% loss demands 67%. %. A 50% loss, which happens more often than amateurs admit, requires a 100% recovery. These percentages expose the silent structural killer inside most trading accounts. Oversizing magnifies losses to the point where even a winning system becomes mathematically hopeless. You can have a 60% win rate with clean entries and disciplined exits, and still spiral downward if a single oversized loss erases 10 carefully earned gains. Professionals understand this instinctively, not because they are smarter, but because they have lived through the cost of violating the math. They build their structure to avoid the trap entirely by keeping their initial size small, by placing their stop at a logical distance that reflects structure rather than fear, by adding only when the market is already paying them, and by letting confirmed strength finance the larger exposure. This transforms the entire risk profile of the trade. It creates positive asymmetry where the downside is capped at a tiny, predictable amount while the upside expands with confirmation and momentum. Imagine a professional entering a trade with only a $1,000 risk, just a small probe that tests the market's intention. The price begins to move favorably, the trend cleans up, and the tape strengthens. He waits, he watches, he sees continuation, volume expansion, and clean behavior around the pivotal points. Only then does he add another $1,000 of risk. The trend strengthens again. The market rewards his patience, and as the move accelerates, he adds a final tranche of risk. His total exposure grows only because the market validated his thesis each step of the way. If the move had failed early, his initial loss would have been a trivial $1,000, barely a scratch on the account, barely a whisper on his psychology. This structure allows him to take the same setup repeatedly without emotional damage or financial burden. Over time, this compounding of clean attempts creates the long-term expectancy that amateurs never reach. Now contrast this with the amateur's structure. All $5,000 committed at entry. No room to add. No space to breathe. No ability to view the early volatility as normal market behavior. No psychological stability. And worst of all, no mathematical edge. The amateur locks in negative asymmetry the moment he enters the trade. Even if he wins a handful of trades, the inevitable oversized loss wipes months of progress. The math does not forgive him. The market does not reward hope. The system collapses under the weight of one mistake. This asymmetric burden is why the 1/5 position rule becomes indispensable. The rule says, never size a trade larger than 1/5 of the amount you emotionally want to risk. This creates a built-in buffer against the catastrophic loss that destroys expectancy. Even when your initial position gets stopped out, the loss is trivial, predictable, and emotionally manageable. Because the first loss is harmless, you remain able to take the same setup again if the trend reasserts. This is one of the hidden advantages professionals exploit. They understand that the market often sets up a valid structure, fakes out early entrants, and then reasserts the trend with more clarity. Amateurs miss this second entry because the first oversized loss damages them. They no longer trust the setup, not because the market invalidated it, but because their size crippled their judgment. The professional, protected by the 1/5 rule, is free to re-enter the structure without fear because the previous loss cost almost nothing. Staying power compounds into opportunity. A trader who can survive long enough to take multiple attempts on high-quality setups naturally ends up on the right side of the move when it finally runs. This is where expectancy grows, not from prediction, but from survival. Now, consider the mathematical beauty inside a properly structured pyramid. The professional's exposure expands in alignment with probability. His risk grows only when the trade grows safer. His worst-case loss is equal to the initial probe. His best-case reward is the performance of a fully built position carried by confirmed momentum. This relationship is the definition of positive asymmetry. The downside is fixed, and the upside is open. The amateur's structure is the inverse. His risk is largest at the most dangerous part of the trade at the beginning when nothing has been confirmed. His reward is smallest when probability is highest, because by the time the move proves itself, he is too scared, too depleted, or too trapped to add size. He pyramids in reverse, putting size in the wrong places. The math of this structure guarantees negative expectancy, even if his analysis is correct. This is the secret few traders ever realize. Expectancy is not built from accuracy. Expectancy is built from structure. A trader with a 50% win rate, but proper sizing, can grow capital. A trader with a 70% win rate but oversized positions can lose everything. The math punishes structural errors the same way gravity punishes heights. It does not negotiate. It does not care how smart you are. It simply enforces the imbalance between loss size and recovery requirement. The 1/5 rule rewrites the entire expectancy equation by hard-coding survival into your process. It ensures that no single trade has the power to break your account, your confidence, or your psychological clarity. It means that the worst possible outcome is a small, controlled loss, while the best possible outcome is a fully pyramided position riding a confirmed trend. It gives you freedom to let a move develop without suffocating it with oversized fear. It allows you to tolerate noise without misinterpreting it as danger. It allows you to re-enter cleanly after a shakeout without emotional hesitation. This is how professionals stay in the game long enough to catch the big moves that define their year. They understand a maxim amateurs never internalize. Your job isn't to predict. Your job is to survive long enough to profit. And this brings us to the final step, because once you combine the psychological protection of small size, the structural clarity of proper stop placement and confirmation, and the mathematical power of asymmetry, you arrive at a protocol that is repeatable, disciplined, and durable. In Chapter 5, we bring everything together, the psychology, the structure, the math, and merge them into one final framework you can begin applying tomorrow morning, a framework that turns size from your biggest liability into the backbone of your trading edge. You now understand the psychology, the structure, and the math, but none of it matters unless it becomes something you can actually execute, something that removes hesitation in real time and gives you the kind of clarity professionals operate with instinctively. The market does not reward intelligence, theory, or good intentions. It rewards consistency born from protocols that operate even when your emotions are uncooperative. Professionals don't rely on discipline because discipline is unstable. Sleep, stress, fatigue, hormones, the last trade, the last mistake, all of it contaminates discipline. Systems, however, don't fluctuate. Systems operate with or without emotion. And the 1/5 position rule becomes powerful only when it evolves from an idea into an unbreakable workflow you follow every single time your cursor hovers over the buy or sell button. The first step in the protocol is identifying what I call your emotional number. This is the number that surfaces when you ask yourself, honestly and without performance, how much do I want to risk here? Quote, not the correct number, not the rational number, the emotional number, your instinctive, impulsive risk. That number is always inflated because it's pulled from excitement, fear of missing out, overconfidence, or impatience. The moment you take that number and divide it by 5, you expose bias instantly. You cut through the illusion of confidence and arrive at the size you can actually execute without trembling hands, without premature exits, without the need to pray for confirmation that may never come. This single step disconnects your size from your mood and anchors it instead to long-term survival. Once you have your real risk, not your emotional fantasy, you begin the probe. Most traders don't know what a probe really is. They think of it as a tentative entry, a half-hearted commitment. But in professional trading, a probe is a diagnostic tool. It's a question you ask the market. Are you ready? The probe is not about making money. It is about gathering information. Your initial position is deliberately small, not because you lack conviction, but because you refuse to let conviction outrun price. You set a logical stop at the true pivotal point, not the convenient point, not the I hope it holds point. The correct stop is always at the price level that invalidates your entire idea. If your probe makes you feel fear, tension, or agitation, your size is still too large. Your internal state reveals the truth faster than your strategy does. A real professional can sit comfortably in a probe because its loss is trivial, forgettable, replaceable. And when your loss is trivial, your mind stays open, your eyes stay sharp, and your ability to re-enter should the market set up again remains intact. After the probe, the next step is the step amateurs fail at most consistently, waiting for confirmation. This is the moment where impatience assassinates more accounts than any indicator ever could. Waiting is not passive. Waiting is a position. Waiting is a skill, just like reading tape or identifying trend strength. Professionals sit through the uncertainty because they are not emotionally entangled with their initial size. Amateurs, oversized from the start, cannot wait. The market is moving against them, or it is moving too slowly, or it is moving without them. They chase because they have no space for patience. But if your probe is only 1/5 of your emotional impulse, waiting becomes easy because the outcome of the probe is irrelevant. You can take 3, 4, even 5 probes in the same direction over the course of a trend, and still be down less than an oversized beginner loses in a single forced entry. Confirmation is the market saying, yes, this is real. And until it says that, you do nothing. When the confirmation finally appears, the protocol shifts into the next phase, pyramiding like a professional. The first rule is absolute. You add only when the market is already proving you correct. A trade that moves in your favor, with clean structure, supportive volume, shallow pullbacks, and tape that reflects genuine strength, becomes a candidate for the second unit of risk. But even here, the adds are controlled. Each addition is equal to or smaller than the previous one, never larger. You build size the way a builder constructs a skyscraper layer by layer, only after confirming structural integrity. This protects you from the delusion of certainty. Amateurs add aggressively when they feel confident. Professionals add cautiously when price confirms. There is a difference between feeling right and being right. Adding into strength means you require the market to pay for your size. The concept is simple. You let the market finance your aggression. When your first unit is in profit, the second unit is no longer a burden. It's an extension, supported by strength. When both are in profit, the third becomes possible. This is how large positions are built without emotional strain and without the catastrophic downside exposure amateurs face by going all in at the start. But the protocol contains a hard line you never cross. You never add to a losing position. This single rule separates survivors from casualties. Averaging down is the logic of ego, not mathematics. It is the belief that your opinion matters more than price. Professionals know that price is the only truth. When you add to a losing position, you are not improving your entry. You are amplifying your error. You are increasing size when your information is weakest. You are expanding exposure precisely when the market is disproving your thesis. Nothing destroys accounts faster. The professional adds only when right because that is when probability and information are aligned in their favor. The amateur adds when wrong because he cannot accept being wrong, and that is why he eventually breaks. As your position builds through confirmation, you close the loop. This is the moment where you acknowledge that your total position was not born from conviction or prediction, but from validation. You let price tell you what to do at every stage. Your eventual size, whether 1 unit or 5, was determined not by desire, but by evidence. This is the essence of professional asymmetry. Your downside was tiny at the start, but your upside expanded as the market unfolded. You took the smallest risk when uncertainty was highest, and you increased risk only as uncertainty decreased. Amateurs do the opposite. They take the largest risk at the point of maximum uncertainty, and then they freeze, unable to act intelligently as the market clarifies. The 1/5 rule restores clarity by solving the real psychological problem: emotional weight. When your size is too large, every tick against you feels like a referendum on your skill, your intelligence, your future as a trader. You become reactive, fearful, desperate. When your size is small, your mind is free to observe. Patience becomes natural. Holding becomes effortless. Your decisions become clean instead of contaminated by fear. This leads to consistency, which leads to compounding. Not compounding capital, compounding clarity. Every clean repetition strengthens your ability to execute the protocol instinctively until it becomes the new baseline from which your entire trading identity operates. The 1/5 rule also restores survival. When you operate with small probes and confirmation-based adds, You have the capacity to take multiple shots at the same setup without emotional damage or financial ruin. Trends are messy. Breakouts fail before they succeed. Reversals tease before they commit. Amateurs burn their entire day's risk on the first attempt. Professionals can take 5 small attempts and still be positioned for the real move when it arrives. This is why they outperform. Not because they predict the market better, but because they survive the noise long enough to catch the signal. Survival is the real edge. Without survival, no strategy works. Without survival, no breakthrough ever arrives. The protocol ends with a simple maxim that captures the entire philosophy in one line. Small size builds patience. Patience builds clarity. Clarity builds profit. This is the architecture of professional behavior. You don't earn clarity first. You earn it through reduced emotional load. You don't become patient through motivation. You become patient through structure. And you don't become profitable by being right. You become profitable by avoiding the conditions that destroy traders long before they ever reach consistency. If this resonated, if the structure settled into place and you now understand the true mechanics of risk, then the next step is to refine your timing. The next video on the pivotal point method will show you how professionals enter with surgical precision, identifying the exact price levels where trends ignite, fail, reverse, or explode. When you combine the 1/5 protocol with correct pivotal point timing, you are no longer trading randomly. You are operating like the traders who survive long enough to compound, long enough to gain mastery, long enough to actually win.